This is the Money Hour with your host, Tina Mitchell, on Alternative Talk, AM 1150. Now, back to the show with local mortgage and finance expert, Tina Mitchell.
Welcome back to the Money Hour with your host and mortgage expert, Tina Mitchell, right here on 1150 AM KKNW, the Saturday, October 4th show. I'm empowering our community, protecting you with opportunities and solutions when it comes to your money. If you're hearing my show at a different time or day, you are listening to a rebroadcast, but you can always call into the show at 1-855-400-1150. Again, that's 1-855-400-1150, and I can answer any questions you have, or better yet, I can connect you with any of the guests that I have in studio today. And in studio right now, Mark Pellegrino with Rainier Group. I have an exciting resource in studio today to give you the knowledge that you need when it comes to your money. And we're going to talk a little bit about what's happening in Mark's arena and the financial arena. And I'm just excited, Mark, to have you back in studio again. Thank you so much for coming in and spending time with me.
Sure. Great to be back.
More importantly, thanks for coming in and sharing time with my listeners.
You bet.
And a little bit about Mark as president of Rainier Group Investment Advisory. Mark brings over 27 years of investment advisory experience to the firm, including directing equity research efforts, equity funds management, private and institutional client portfolio management, and the development of mutual fund, complex and alternative investment platform. So, Mark, let's go ahead and start out, ask a question in regards to, seeing that the Dow and the S&P 500 hit new highs again recently. What's driving the markets right now?
Yeah, they did hit those new highs mid-September. We are in a bit of a pullback now, though, which we really see as a correction rather than a sustained move lower. Aside from that, the same factors that have driven the markets higher during the course of the recovery are still pretty much intact. One of those, as we talked about in a previous show, is what we've been calling the Tina effect. I thought you'd like that.
Nice.
That stands for there is no alternative. So when you realize that interest rates are still at awfully low levels and likely to remain there for a bit, the yields on fixed income investments aren't offering up the kinds of competition for potential stock returns as they ordinarily would. We also see still a strong propensity by investors to buy the dips. We've now had, this is the fourth correction during the course of this year in the markets, and none of them have exceeded 5% from peak to trough. And I think that's some evidence of some complacency in the minds of investors. And then finally, I would add that the Fed is still in an accommodative stance where and supportive of the financial markets, and if you believe what the Fed has said about their intentions from here, we may be in this place for a little bit yet.
Yeah, and it's actually surprising to see that. So there is still so much support, because it feels like everything is just getting a lot more secure and stable with what's happening, that they could, they can back off on that. Well, Mark, on the other side of the coin, where are your concerns? Because I'm sure in your arena, and even more so than mine, I mean, I deal with it sometimes myself. I have a hard time falling asleep, wondering what's going to happen in the future. What are your concerns, and what's keeping you awake at night?
Well, over the past 3 to 4 years, we've had these big economic events lurking on the horizon, whether it was a European debt crisis, fiscal cliff, government shutdown. There was a lot on that front to be concerned about, and the market certainly went through some volatile times in dealing with that. This year, however, now that those things are largely off the middle of the radar screen, it's on the geopolitical front where the concerns seem to come in, and there's plenty out there to chew on. Ukraine, Russia, ISIS, Iraq, Hong Kong, South China Sea, Gaza Strip, Ebola. Yeah. But a lot out there right now that has the markets a little bit spooked, I think.
So, Mark, speaking of Ukraine, what effect do you see the situation there having?
Well, that one actually is the only one of those geopolitical scenarios that I described that has, in our opinion, any immediate or significant economic impact. The tougher sanctions offered up by the West, especially Europe, and then the counter sanctions coming back from Russia we believe really do run the risk of flipping Europe back into at least a mild recession. And that, of course, would have an effect on the rest of the world's economies and probably on the markets as well.
So with the unknown and just, not knowing what's going to happen, obviously there's risk in everything that we do. How do you go about understanding your clients' return expectations and their true appetite for their level of risk?
So, I think most firms in our business try to be good listeners, ask all the right questions when they're engaging a new client and trying to understand what the best investment strategy for them would be. And that's not lost on us. We spend a lot of time in those endeavors as well. But we combine that with that particular exercise with empirical evidence. And one of the ways we do that is through a proprietary and very sophisticated financial modeling platform. And this really helps us understand what investment strategy is right for our clients. We've also supplemented that more recently with what we call a risk-return matrix. And this is essentially a 4-factor model that helps us understand both our clients' required return but also their desired return, all of that within an appropriate level of risk.
That's awesome, Mark. I think it's so important to, as you said, listen to your clients and find out what their needs are, because each of us have different needs, and so it is really important. I've heard the term decoupling and used in financial media recently. What is that? What's it about?
Well, we really are in a bifurcated economic environment right now. Overseas, both in Europe and the emerging economies of the world, and I put China at the top of that list, we're seeing some real slowing in economic growth. I mentioned the fact that Europe could, in fact, slip back into recession. China and the rest of the emerging economies of the world have clearly slowed in terms of their economic growth. And all of that at the same time that the U.S. economy appears to be accelerating as we move through the second half of the year. We describe this as the U.S. being the best house in the global neighborhood. Mm-hmm. And as such, we've established an even more significant overweight to U.S. securities in our clients' portfolios while maintaining a pretty meaningful underweight to overseas securities.
So, Mark, we've been in a jobless recovery since the big recession. Do you see any improvement in the employment situation, or is real improvement likely to remain elusive?
Well, throughout the course of the year, we have been seeing some modest and fairly consistent improvement in at least the headline figures on employment. But when you look inside those figures, what you find is that the labor force participation rate is still stuck at awfully low levels, meaning a lot of people have left the workforce, many of them permanently, and until you fix that issue, we still are a long way from what the Fed would consider full employment in our economy. And that, I think, has kept the Fed, among other things, in the accommodative stance we talked about earlier.
Mm-hmm. So, Mark, there's been a lot of great deal of buzz about Michael Lewis' book, Flash Boys, and the subject of high-frequency trading. What are your thoughts about Mr. Lewis and what he's offered up?
Well, it certainly helped him sell a lot of books and kept him on the speaking circuit for quite a while. Mm-hmm. But setting that aside, there's no doubt that high-frequency trading has had a meaningful impact on the investing landscape in both good and bad ways. Most importantly, it's made it a lot more difficult for the individual investor to compete in the markets these days. I guess I'm mostly indignant about these high frequency trading practices in that these traders are neither taking risk nor creating value, and that's not the way the markets are supposed to work.
Yeah. So, Mark, I'm really curious to see what your thought on this. Obviously, me doing mortgages for a living, I've got my thought as well. But, we've seen declining interest rates since the early 80s. And it's weird for me to say I'll be married 20 years November 4th of this year. And I'll actually be doing mortgages for 20 years in May of next year, 2005. So big 20-year thing going on here. But ever since I've been doing mortgages, the interest rates have just been outrageous. Now, obviously, the last few years, much lower. What do you think the market's going to do with rates?
Well, first of all, we don't see a sustained increase in interest rates as being immediately upon us. But if you believe what the Fed has said about their intentions, if you believe what the bond markets appear to be telling us about the timing of a likely increase in rates, consensus would probably have us out into the middle of next year before we begin to see that. Now, it's likely that the institutional bond investors out there might get out ahead of that. Time will tell. The triggers on watching for that moment in time would be an improvement on the employment front, which might create an acceleration in economic growth, and with it would come inflationary pressures, and I think that might induce the Fed to step up the process of raising rates. We're already beginning to position the fixed income portion of our clients' portfolios for that eventuality.
Yeah, it makes total sense, Mark. Are there any special themes playing out in the economy right now you want to share with my listeners? Yeah,
one comes immediately to mind, and that's the U.S. energy renaissance that is quickly taking shape here in the U.S., where the U.S. is now becoming energy independent for the first time in forever. We've chosen to play that through targeted positions in energy services, which would be the drilling companies, the energy transport companies, et cetera, that supply, that provide services to the big integrated oil companies, and also through the natural gas pipeline sector. And that's just an example of some of the targeted, more opportunistic investments we like to make in our clients' portfolios.
I have you in studio because you are one of the best. I appreciate so much your time that you take to share your wealth of information with my listeners. And again, if you want to talk to Mark directly, please pick up the phone, call the show at 1-855-400-1150. Again, that's 1-855-400-1150. I always wish I had more time with my guests, but I like to split it up and have a few different topics in here. But we only have an hour, and there's so much information and so many questions I'm sure all of you have when it comes to your finances and how to invest. So again, I highly encourage for you to give Mark a call. Mark, thank you so much for coming into studio. It's always great to see you.
Great to be here. Thanks.
And coming up next on the Money Hour, protecting homeownership and a great resource for our local realtors. Russ Hokanson, CEO of Seattle-King County Association of Realtors. He is right here on 1150 AM KKNW after this short break.